All right, welcome to The Explainer. Today, we're diving deep into the Merceh Co case study. You know, the one for the SBL exam. We're going to deconstruct this thing piece by piece, turning the pre-seen material into a really clear strategic briefing. The goal? To give you those critical insights that'll help you absolutely smash this exam.
So let's just start with this. I saw this on Reddit and it says it all, doesn't it? It's a magazine industry crisis. That single comment, that emoji, it just perfectly captures the heart of the problem for Merceh Co. We're talking about a company in an industry that's, well, facing a total existential crisis. So today, we're going to unpack exactly what that means for their strategy, their future, everything.
Okay, so here's how we're going to tackle this. We've got 6 key areas to cover. We'll start big picture with the industry, then zoom right into Merceh's operations, the numbers, the risks, the whole shebang. And we'll finish up with the tough questions you need to ask the board. Let's jump in. All right, section 1. First things first, we've got to set the scene. The magazine industry in this place, Darland, it's in a state of just massive disruption. You really can't understand Merceh's problems until you understand the world that they're trying to survive in. So, look at this number, $8 billion. That's the total annual revenue for the market in Darland. It's a big pie, right? But, and this is a huge but, don't let that big number fool you. This is a market that's going through a really fundamental and, honestly, a pretty painful shift away from what it's always known, print. So here's the snapshot of the industry. And the challenge is, well, it's brutally clear. You've got the top 5 publishers, Merceh included, controlling half the market. But the demand for their core product, physical magazines, is just falling. Why? Well, because the internet is just flooded with free content on all the same topics, so readers are leaving. And when the readers leave, what happens? The advertisers follow them. So that's a double whammy. Revenue from sales is down, revenue from ads is down. In this kind of environment, it's pretty simple. You either adapt or you get swallowed up in a takeover.
Okay, so that's the industry. A bit grim, right? Now let's see where our company, Merceh Co, fits into all this. How is this 60-year-old giant actually handling this chaos?
So who is Merceh? Well, they're a huge established player. We're talking 60 years old, listed on the stock exchange, and they publish over 300 different leisure magazines. 300! This is not some nimble little startup. This is a big old incumbent, a giant with really deep roots in the old way of doing things. And that's a key part of the story.
Now, this is a really critical piece of the puzzle, the ownership structure. Okay, so you see institutional shareholders have 60%, the majority. But look at this. The directors themselves own 30%, a 30% stake. Now, on one hand, you might think, great, they're motivated to perform. But on the other hand, and this is a big one, it creates a massive potential conflict of interest. Are their decisions truly for the long-term survival of the company, or are they maybe, just maybe, more focused on protecting the short-term value of their own shares? Keep that question in your back pocket. It's going to be important later.
Okay, let's get into the nitty-gritty. How does Merceh actually work day to day? We're going to look at their operating model, their value chain, because they do some things that are, well, very different from their competitors. And you absolutely have to understand this to see where the problems are.
So the production process itself, it's pretty standard, very traditional stuff. You know, the editor-in-chief plans an edition, writers write, editors edit, designers design. Step by step. But the really interesting part, the thing that's super important, is what happens at the end, that final step, publishing.
And here it is. This is a huge strategic choice they've made. See, most publishers in Darland, they outsource their printing. It's cheaper, it's more flexible. But Merceh? Nope. They do it all in-house. They own the printing presses. They run their own central distribution hub. Now think about that. That means massive fixed costs. A ton of money tied up in buildings and machinery. In a growing market, that control might be a strategic advantage. But in a market where print is dying, it starts to look like a really expensive anchor, dragging the whole ship down. Okay, let's talk about their digital side. Their whole digital publishing strategy is built on what the case calls an aging platform, and it only offers basic customization and some analytics. That, right there, is a massive red flag. In today's world, you need a dynamic system. You need to be able to personalize content for every user. You need deep data analytics to figure out what people actually want. You need smart paywalls. It's pretty clear their old system can't do any of that,
which puts them at a huge, huge disadvantage against, well, everyone else online.
All right, now for the data. And this is where things get really interesting because the numbers tell two completely different stories. The financial statements on the surface, they tell one story, but the operational data underneath, that tells a much more alarming tale. So if you just glance at the top line numbers, you think, hey, things look okay. Total revenue is actually up a little bit over the last 5 years, hitting $650 million. And look at the operating profit. It's incredibly stable, just hanging around $185 million. If you're a director on the board, you might look at this chart and think, see, we've got this under control. Everything's fine. But then you look at this, and this chart just perfectly shows the crisis hiding under the surface. While the money looks steady, the actual volume of their main product, the number of magazines they sell, is absolutely falling off a cliff. From 4.1 million down to 3 million. They've lost more than a quarter of their sales volume in just 5 years. That's not just a red flag, that's a giant, flashing, screaming alarm bell. So, this brings us to the big, critical question, right? How is this possible? How can your profit be stable when your sales are tanking so badly? What are they doing to prop up those numbers? Are they jacking up prices on the magazines that people are still buying? Are they cutting costs to the bone? Or is it possible their digital stuff is growing just fast enough to plug the hole? The case doesn't tell us, but what it does show is a business whose entire foundation is crumbling, even while the front of the house still looks painted and pretty. So the question is this sustainable, or is it just a mask for a much, much deeper problem? Which brings us here to this strategic minefield that Merceh is trying to walk through. And believe me, there are mines everywhere. The company is being pulled in all these different conflicting directions with huge threats coming at them from all sides. I mean, just look at this. They're basically fighting a war on two fronts. On one side, you have the old world, print. They're dealing with rising paper costs, supply chain problems, high distribution costs, and of course, readers just not buying magazines anymore. It's a slow, painful retreat. But on the other side, they have to fight in the new world, digital. And there they're up against cyber threats, their own platform failing, endless free competition, and the whims of search engine algorithms that can wipe you out overnight. It's a battle for survival on both sides. And as if that wasn't enough, there's more. Beyond that core print versus digital fight, you've got this whole list of other major threats. The whole industry is consolidating, so could Merceh just get bought out by a bigger fish? They rely way too much on a few key freelance experts. What if those people leave? Then you've got regulators breathing down their neck, the risk of a bad economy where people stop buying leisure magazines, and even climate change and CSR pressure. I mean, any one of these could be a company killer on its own. They're facing all of them at once. So, we've laid it all out. The industry, the company, the data, the risks. Now we get to the most important part. If it were you, if you were the one walking into that boardroom to brief the directors of Merceh, what are the big, tough, strategic questions you would put right on the table? This is where analysis has to turn into action. Question number 1. You have to go right after their oldest, proudest tradition, that in-house printing operation. You have to ask them, is this thing really a strategic strength that gives you control? Or is it just a costly liability, an anchor of fixed costs that's dragging you to the bottom in a market where print is dying? Is it stopping you from being nimble enough to actually invest in the future? Question number 2 is all about tech. You have to look them in the eye and ask if they seriously have the right tools to win online. Their mission statement is all about providing expert content that engages people, but can their ancient digital platform really create an experience that's so good, so valuable, that people will actually pay for it when there are a million free competitors out there? Or are they just taking their old magazine and, slapping it on a website? Is that really enough? And that brings us to the final and maybe the toughest question of all. This one is aimed squarely at the directors and that 30% stake they own. The real question is about courage. Does this board, does this leadership team have the guts to make the incredibly painful choices that are needed to survive long term? Are they actually willing to cannibalize their own profitable but dying print business to properly fund a risky, uncertain, but absolutely essential digital future? It means sacrificing today's stable profits and maybe even the value of their own shares for a chance at tomorrow. And that right there is the billion-dollar question facing Merceh Co.